Well, hello traders, Chris Weston here, Head of Research at Pepperstone. One of the strong messages that I've been pushing for the last few weeks has been this massive divergence we've been seeing amongst various asset classes. Certainly if you have a look at equity markets, they've had a very strong move up through January, February and into March, and that's telling you a fairly bullish story. And if you look at the S&P, you can see it's back testing this key supply level around the sort of 28.15, 28.20 level, where if we can see a firm close above that level, then one really has to think that we go on to test new all-time highs coming through there. You can have a look at the high yield versus investment grade credit spread, and we can see that's been collapsing for the last few months in line with what we've been seeing with the S&P, and perhaps that has been the predominant driver and the backbone behind the rally in the S&P. When you see that outperformance from high yield, people are ready to take risk on, and credit markets at the end of the day are about 4 times the size of equity markets. So when we see those high yield spreads working quite nicely, we know that there's some positive feel to the world, and perhaps it's going to be the time when the debt markets reopen again and companies can go back and issue high yield paper going forward. But something we are watching there is that story. And of course, if you go into the commodity story, copper's trading back at 293. You've got the oil price, which I think is absolutely key, largely driven by what we've been seeing from OPEC and the Saudis, but also what we've been seeing in the inventory supply numbers there, where inventories have been coming down. Gasoline has been driving the move, and gasoline has been very, very strong of late, and you can see that really positive trend. So there's a very bullish message that's being portrayed through these markets going forward. And here in the Australian market, the ASX 200, we've got the index just pushing 6,200 at the moment, and we're seeing all sectors looking pretty rosy at the moment for 2019. The other message that, of course, we have been suggesting is the message that's being portrayed in the bond market and also in the rates market. And I think front and centre is really what's happening in Australia and the US, where in Australia we can see that about 41 basis points of cuts are being priced into the swaps market over 12 months. And in the US, if we go further out the euro-dollar curve, you can see 20 basis points of cuts being priced in from the Fed for 2020. That basically means that we're going to see an extended pause, and we're going to see likelihood of policy easing from the Fed, which stinks and reeks of policy mistakes from the Fed in terms of the market's interpretation of that. So we do have those clear divergence playing through. But I think ultimately, how does this feed into valuations? And perhaps the fact that equity prices are at these current levels is actually a function of rate easing, and actually a function that we are seeing bond yields where they are at the moment. And if we take the ASX, for example, the fact that we're trading on about 15.8 times forward consensus earnings. Now, throughout this period of uncertainty, we haven't actually seen earnings expectations really rolling over too much, and they've actually started pushing higher again. The question we need to ask ourselves, if the equity market is to trade north of 6,500 going forward, is what is going to be the influence on a macro perspective that is going to drive the multiple that investors are prepared to pay up to, say, 16 and a half times forward earnings. Unless we do get a radical shift in those earnings expectations, is the market prepared to pay more for the market? And are they prepared to pay a multiple which they were last year of, say, 16 and a half times forward earnings? And that would give us a potential valuation of the ASX 200 of, say, 6,600. Now, if you have a look at the bond market, I think it's really interesting to see that nominal bond yields on the 10-year have pushed below 2%. You can see on the front end of the 3-year below 1.5%, actually below the cash rate. Now, that's very important if we are to get the cash flows of the ASX 200 companies and actually discount them using the risk-free rate. Those cash flows are becoming ever more compelling. But also the dividend yield for the ASX 200 is being reinforced as the opportunity cost of being invested in cash, of the opportunity of being investing in the fixed income market is diminishing. So forth, the dividend yield of the ASX 200 is becoming more reinforced and actually more compelling in that situation. So the bond market is obviously a very key influencer, and if you actually adjust for inflation expectations, you can see in Australia that real yields are trading around 48 basis points, which is really not very compelling when you compare that to the dividend yield you can get going forward in the ASX of 4.8%. So there you can see what happens when falling yields are reinforcing the idea that the ASX should be going higher. Can yields continue to go lower and reinforce that dividend yield? I'm not so sure. I think they look fairly valued, and the fact that the market is pricing in so much over the next 2 years is giving us an indication of that bond yields probably can go a little bit lower, but I think the downside seems to be relatively well capped in this scenario. The big concern, of course, is the global growth story. But what happens if we do see a turnaround in global growth going forward? Of course, that will give us some optimism that we can prepare to pay a little higher multiple and perhaps pay 16.5 times for our market. Oil prices, if they continue to go higher, that's going to probably see energy being re-rated, and that could boost the earnings multiple of that situation from $400 even higher than where we are. And it'd give us some confidence as well that inflation expectations are going to go up, and that would see real yield going down as well. Another big positive for our market. If we have a look at the US-Sino relations, well, I think the market's fully discounted or largely discounted a peaceful or a positive resolution going forward, and I don't think people are really concerned about Brexit outside of pound traders at the moment. So I think with outside of global growth, if we do see that deteriorating, yeah, I think people are going to say, well, we're happy and fairly content to pay 15.8 times forward earnings, and we're not going to pay much more, in which case our market is fairly valued at current levels. But what is going to see us prepare to pay over 16 times forward earnings? And that's where we start seeing the big multiple re-ratings for this market and the big upside going forward. And that's the question you've got to ask yourself at the moment is, why are we going to pay more for this market when it's fairly valued at this moment? What is going to cause the macro to incentivize to pay us more in this market? And that's the question you've got to ask yourself here.